Before we dive in, let me be crystal clear. I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The world of insurance is complex and state-specific. You should always consult with a qualified and licensed insurance professional to discuss your individual needs before making any changes to your policy. This video is not a substitute for professional advice. Imagine this for a second. You're driving home from work on a Tuesday. It's been a long day. You're thinking about what to make for dinner. You're stopped at a red light, listening to a podcast, completely in your own world. The light turns green. You ease your foot onto the accelerator of your trusty 10-year-old Toyota Camry, the one you're so proud of because you finally paid it off last year. You follow Dave Ramsey's plan to a T. You're debt-free except the house, you've got your emergency fund, and this paid-off car is a symbol of your financial freedom. Then out of nowhere, bam! A blur of red metal blows through the intersection and T-bones your driver's side door. The sound is deafening. Airbags explode in a cloud of white powder. Your perfect, reliable, paid-off car is a twisted wreck. Thankfully, you're mostly okay, shaken, bruised, but alive. But as you stand on the side of the road, looking at the wreckage, a cold, sinking feeling starts to creep in. You followed the Ramsey rules. You dropped collision coverage the second the car was paid off to save money. You jacked up your deductible to $1,000, maybe even $2,000, to get that premium as low as possible. You did everything right. Or so you thought. Now you're facing the gut-wrenching reality that not only is your only mode of transportation completely gone, but you're on the hook for the entire replacement cost yourself. The other driver's insurance might pay eventually after months of fighting, if they even have enough coverage. Your emergency fund, the one you scrimped and saved for years to build, is about to be wiped out by one bad driver. This isn't a scare tactic. This exact scenario plays out every single day across America. And it exposes the single biggest, most dangerous blind spot in the Dave Ramsey financial philosophy. For millions of people, his advice on car insurance is a ticking time bomb. A financial landmine planted right in the middle of their path to wealth. And in this video, we are going to expose it, dissect it, and give you the modern framework to protect yourself properly. We're going to show you how to take the rock-solid principles Dave teaches and apply them to the reality of 2024, not 1994. You will walk away from this knowing exactly what coverage you need, why you need it, and how to get it without getting ripped off. You'll learn how to build a policy that actually protects your journey to becoming an everyday millionaire, instead of derailing it at the first sign of trouble. Now let's be fair. Dave Ramsey has done more to help people get out of debt than almost anyone on the planet. His 7 baby steps are simple, effective, and have changed countless lives. When it comes to getting gazelle intense and paying off credit cards and student loans, his advice is gold. But when it comes to insurance, the philosophy gets a little shaky. It's built on a few core ideas. First, always take the highest deductible you can afford to lower your premium. Second, as soon as your car is paid off and its value drops, you should drop your collision and comprehensive coverage to save even more money. The logic is simple. Self-insure the small stuff, only pay for catastrophic coverage, and put the money you save toward your debt snowball or investments. Sounds great on a spreadsheet. It makes perfect sense in a world where a good used car costs $3,000 and a fender bender costs a few hundred to fix. The problem is, we don't live in that world anymore. The financial landscape has dramatically shifted, but this part of the advice hasn't kept up. The average price of a used car has skyrocketed over 40% in just the last few years. That reliable 10-year-old Camry isn't worth $4,000 anymore. It's worth $10,000 or $12,000. The cost of car repairs has exploded due to complex sensors, cameras, and computers embedded in every bumper and side mirror. A simple fender bender isn't a $500 inconvenience anymore. It's a $4,000 nightmare. And lawsuits? The value of liability claims has gone through the roof. A minor accident can now result in a lawsuit that threatens everything you own. Following outdated insurance advice in today's world is like navigating a modern highway using a map from the 1980s. You might be heading in the right general direction, but you're completely blind to the new interchanges, the closed-off roads, and the multi-lane superhighways that could either get you to your destination faster or lead you straight into a catastrophic pileup. So let's start with the very first pillar of the Ramsey insurance plan, and arguably the most misunderstood, the high deductible. The advice is simple. Raise your deductible to $1,000, or even higher if you can. The logic is that your emergency fund, your baby step one, is there to cover these smaller emergencies. Why pay an insurance company an extra $30 a month for a lower deductible when you can just cover that cost yourself from your emergency fund? You're self-insuring. You're being a grown-up. You're taking responsibility. Feels empowering. And for many people, this isn't terrible advice on the surface. A higher deductible absolutely lowers your premium, but it's a dangerously incomplete picture. It misses two critical real-world factors. The first is human psychology. Your emergency fund is for emergencies. It's the wall between you and going back into debt when the transmission dies or the air conditioner gives out in the middle of July. When you have a $1,000 or $2,000 deductible, you are far more likely to avoid filing smaller claims to protect that precious emergency fund. You hit a deer and do $1,800 worth of damage. Your deductible is $1,000. Are you really going to file that claim, pay the $1,000 out of pocket, and risk your rates going up all to get an $800 check from the insurance company? Probably not. You'll just drive around with a dented car. Or worse, you'll try to pay for it out of your monthly budget, squeezing your finances and putting stress on your family, because you're terrified of touching that emergency fund. So you end up paying for insurance every month that you're psychologically unwilling to even use. But the second and far more important factor is the math. The cost-benefit analysis has completely changed. Let's run some real numbers. Let's say raising your deductible from $500 to $1,000 saves you $20 per month, or $240 per year. That sounds pretty good. But what happens when you have a claim? You are now on the hook for an extra $500 out of your own pocket. To break even on that decision, you would need to go more than 2 years without a single at-fault accident or comprehensive claim. Specifically, it would take 25 months of savings, $500 divided by $20, just to equal the extra risk you took on. Can you guarantee you won't hit a patch of ice, have a tree branch fall on your car, or get hit by an uninsured driver in the next 2 years? The national average says you'll have a claim every 17.9 years, but that's just an average. It bundles 16-year-old new drivers with 80-year-old retirees. For a typical family with multiple drivers, the odds are much, much higher. You could easily have 2 or 3 claims in a decade. If you have just one claim in that 2-year window, you've lost money. You paid higher premiums for years, and then you also paid the higher out-of-pocket cost. You lost on both ends. The insurance company, meanwhile, collected your premiums and reduced their own risk. It's a fantastic deal for them, but a terrible one for you. The small amount you save per month often doesn't justify the significant financial risk you're taking on your end. So let's paint a picture. You're driving home from work, maybe listening to a podcast, thinking about what's for dinner. The light turns yellow, you slow down, but the person behind you is texting. They don't see you stop. Bam! It's not a huge crash. Your bumper is dented. Their hood is crumpled. Everyone seems okay, maybe a little shaken up. The other driver is complaining about a sore neck. You exchange insurance information, file a police report, and think, well, that's what insurance is for. But a few weeks later, you get a letter. Not from their insurance company, but from a lawyer. That sore neck? It's now a serious spinal injury, requiring months of chiropractic care, physical therapy, and lost wages. The other car, a brand new SUV, is deemed a total loss by their insurance company because of hidden frame damage. Suddenly, the claims aren't just for a few $1,000s. The medical bills are climbing towards $50,000. The replacement cost for their luxury SUV is $60,000. That's $110,000 in total damages. You check your policy. You have that state minimum coverage we talked about. Let's say it's 25/50/25. That means your insurance will pay a maximum of $25,000 for that person's medical bills. That's it. They will also pay a maximum of $25,000 for the totaled SUV. Your policy covers a grand total of $50,000 for this accident. But the bills are for $110,000. So where does the other $60,000 come from? Comes from you. Your insurance company writes their checks, maxes out your policy, and wishes you the best of luck. Now, that lawyer is coming after your personal assets. They can garnish your wages. They can put a lien on your house. They can seize your savings account. Everything you have worked for, your future, your kids' college fund, your retirement, is now on the chopping block because you tried to save $20 or $30 a month on your car insurance premium. That seemingly minor fender bender has just triggered a financial avalanche that could bury you for decades. This is not a scare tactic. This happens every single day in America. And this is the absolute core of why Dave Ramsey is so militant about liability insurance. He knows that one single bad day, one moment of distraction from another driver, can bypass your emergency fund and your budget and go straight for the jugular of your financial life. So, what's the Ramsey-approved answer? It's simple and non-negotiable. He recommends liability limits of at least $500,000. The way you'll see this written on a policy is typically 250/500/100. Let's break that down because it's incredibly important. The first number, 250, means your policy will cover up to $250,000 in bodily injury liability for a single person in an accident you cause. The second number, 500, means your policy will cover up to $500,000 in total bodily injury for everyone involved in that one accident. And that last number, 100, means you have $100,000 in coverage for property damage. That's for their car, or maybe the fence you hit, or the storefront you crashed into. Now you might be thinking, $500,000? Isn't that overkill? My car isn't worth that much. This is the critical mistake people make. Your liability coverage has nothing to do with the value of your car. It has everything to do with the value of what you might hit. And what you might hit is incredibly expensive. The average price of a new car today is nearly $50,000. It is not hard to cause $100,000 in property damage if you're involved in a multi-car pileup. And medical costs? They are astronomical. A single airlift to a hospital can cost over $50,000. A multi-day stay in the ICU can easily run into the six figures. In our little story, that one person's neck injury was $50,000. What if you had caused an accident with a minivan carrying a family of 4? For people, each with serious injuries, you can see how quickly you blow past a $50,000 or even a $100,000 policy limit. The 250/500/100 recommendation isn't about being pessimistic. It's about building a fortress around your finances. It's the moat that protects your castle. And here's the kicker. The difference in premium between pathetic state minimum coverage and robust, protective coverage is often surprisingly small. We're not talking about hundreds of dollars a month. For many people, it might be an extra $30, $40, or $50 a month to increase your protection by a factor of 10. It is, without question, the best money you will ever spend on insurance. It's buying you peace of mind. It's buying you protection against financial ruin. So we've established the first Ramsey rule. Protect other people and their property to the absolute max you can reasonably afford, with a strong recommendation of $500,000 in liability coverage. But what about your own car? This is where the script flips completely. This is where Dave's philosophy shifts from maximum protection to strategic risk. This brings us to collision and comprehensive coverage. Collision, as the name implies, pays to repair or replace your car if you're in an accident. Comprehensive covers you for just about everything else. Theft, vandalism, a tree falling on your car, hitting a deer, a cracked windshield from a rock on the highway. For most people who have a car that's relatively new or has a loan on it, these coverages are essential. But Dave Ramsey has a very different take for a specific group of people. Those who are debt-free and driving older, paid-for cars. His advice is radical to some. Consider dropping collision and comprehensive coverage entirely. Now hold on, before you think that sounds crazy and reckless, let's understand the logic. It's not about being cheap. It's about becoming your own insurance company. He calls it self-insuring. The principle is this. Insurance makes sense when the potential loss is so catastrophic that you could not possibly cover it yourself. A $500,000 liability lawsuit is catastrophic. A $3,000 repair bill on your 15-year-old Honda Civic is not. It's an inconvenience. It's an annoyance. But it should not be a financial catastrophe. Here's the math. Let's say you drive a paid-for car that has a Kelley Blue Book value of $4,000. You're paying, let's say, an extra $70 a month or $840 a year for collision and comprehensive coverage. If you total that car, the absolute most the insurance company will ever give you is $4,000, and that's after you pay your deductible, let's say $1,000. So your maximum payout is $3,000. But you're paying $840 every year for that protection. In less than 4 years, you will have paid the insurance company more in premiums than the maximum amount they would ever pay you in a claim. You are, in essence, betting $840 a year that you will have an accident that totals your car. The insurance company is betting you won't. Guess who usually wins that bet over the long term? Dave's argument is, why not take that $840 a year and put it in your own savings account? You become the insurer. If you get an fender bender that costs $1,000 to fix, you pay for it out of your savings. If you total the car, you take the money you've saved on premiums, combine it with your emergency fund, and you go buy another $4,000 car with cash. However, and this is the most important part of this strategy, this only works if you have one critical thing in place: a fully funded emergency fund of 3 to 6 months of expenses. If you don't have that emergency fund, then dropping your collision coverage is not a savvy financial move. It's a reckless gamble. Without that cash cushion, a totaled car becomes a true emergency. You can't get to work, you can't earn an income, and you have no money to replace your transportation. You're forced into taking out a car loan, and the debt cycle begins all over again. So, the Ramsey strategy is a two-part system that must work together. You go for maximum liability coverage to protect you from the million-dollar lawsuit you can't handle. Then, for your own older paid-for car, you use your emergency fund as the protection, allowing you to drop the expensive collision and comprehensive coverages and save that money. It's about intelligently transferring the risk you can't afford to bear, the massive lawsuit, and wisely accepting the risk you can afford to bear, the loss of an older vehicle. This puts you in control, not the insurance company and not the random chance of an accident. But this creates a new question. What if your car isn't an old beater? What if you have a $10,000, $15,000, or $20,000 car that's paid for? Or even more complicated, what if you have a loan on your car? Then the rules of the game change once again. This is where the math gets a little more personal, and the decision-making process moves from a simple legal requirement to a strategic financial choice. Let's tackle the paid-for car first. You've worked hard, you've saved up, and you own a respectable, reliable $10,000, $15,000, or even $20,000 car, free and clear. The title is in your name. Congratulations, that's a huge accomplishment. But now, when you look at your insurance options, you see two expensive-sounding words: collision and comprehensive. This is what most people mean when they say full coverage. It's not an official term, but it's the common way to describe a policy that includes not just liability, but these two critical protections for your vehicle. Let's break them down in the simplest way possible. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a tree, a guardrail, or a light pole. The most important thing to remember about collision is that it pays out regardless of who is at fault. If you cause the accident, your liability insurance pays for the other person's car and medical bills. Your collision insurance is what pays for your car. If someone else hits you and they have good insurance, their liability should cover your car. But if they're uninsured or underinsured, a terrifyingly common problem we'll discuss later, your own collision coverage can be your saving grace. Comprehensive coverage, on the other hand, is for almost everything else. Think of it as the act of God or life happens coverage. Protects you from things other than a collision. A tree branch falls on your car during a storm. A deer decides to play chicken with you on a country road at dusk. Your car gets stolen from your driveway. A hailstorm makes your hood look like a golf ball. Vandals break your windows. All of these scenarios, that's what comprehensive coverage is for. So back to your $15,000 paid-for car. Do you need these coverages? Dave Ramsey's philosophy on this boils down to one simple question. Can you afford to replace the car tomorrow with cash without it derailing your financial life? This is where the emergency fund comes back into play. Remember, the entire purpose of insurance is to transfer a risk that is too big for you to handle on your own. A $50,000 liability claim is a risk too big for almost anyone. That's a catastrophe. But what about a $15,000 loss? For most people, that's still a massive gut-wrenching hit. If you wrecked your car and didn't have collision coverage, would you have to drain your entire emergency fund to get back on the road? Would you have to go into debt to buy another car, undoing all the hard work you did to pay this one off? If the answer is yes, then you are not yet in a position to self-insure. You need to transfer that risk. You need to pay for collision and comprehensive coverage. Dave's rule of thumb is pretty clear. If the value of your car is significant enough that losing it would be a major financial setback, you keep full coverage on it. For most American families, a $15,000 car absolutely fits that description. The monthly premium for that coverage is the price you pay for peace of mind, the price you pay to protect a major asset. But here's where the Ramsey strategy gets clever. He doesn't just say buy full coverage. He says to buy it smartly. And the key to doing that is the deductible. The deductible is the amount of money you have to pay out of pocket before your insurance company pays a dime. It's your skin in the game. You can choose a low deductible like $250 or a high one like $1,000 or even $2,000. The insurance company knows that the vast majority of claims are small, fender benders, scraped doors, cracked windshields. By choosing a low deductible, you're telling the insurance company you want them to handle all these little things. And for that privilege, they are going to charge you a much higher premium every single month. Dave Ramsey looks at this and sees an opportunity. Your fully funded emergency fund of 3 to 6 months of expenses is sitting there for emergencies. $1,000 car repair is an inconvenience, it's frustrating, but for someone with a solid emergency fund, it's not a catastrophe. It's exactly what the fund is for. So his advice is to raise your deductibles. Move them from $250 or $500 up to at least $1,000. The moment you do this, your monthly premium will drop, sometimes dramatically. You are now telling the insurance company, "Look, I'll handle the small stuff. I've got a $1,000 emergency fund, and I can cover the minor bumps and bruises myself. I only need you for the big stuff, the major accidents, the total loss." You are, in effect, self-insuring for the first $1,000 and transferring the risk for everything above that. Over the course of a year, the savings on your premiums can add up to hundreds of dollars, money you can put toward your other financial goals. Now let's shift gears to that other, far more common scenario. You have a loan on your car. This changes everything. The simple truth is, when you have a car loan, it is not your car. You might be driving it, you might be washing it, you might be paying for the gas, but until that last payment is made, the car belongs to the bank or the finance company. They hold the title. And because it is their asset, they get to make the rules to protect their investment. And rule number 1 is that you will have full coverage. It's not an option. It's not a suggestion. It is a contractual requirement of your loan agreement. The lender will mandate that you carry both collision and comprehensive coverage, and they'll often specify the maximum deductible you're allowed to have, usually $500 or $1,000. If you try to drop that coverage, the lender will find out, and they will either take out a policy on your behalf at an astronomically high rate and add it to your loan payment, or they could even declare you in default of your loan. They are not going to let their multi-$1,000 asset drive around unprotected. This brings us to one of the most misunderstood products in the auto world, gap insurance. GAP stands for Guaranteed Asset Protection, and it only exists because of car loans. We all know that a new car loses a huge chunk of its value the second you drive it off the lot. This is called depreciation. It's not uncommon for a person to owe, say, $25,000 on a car that, a year later, only has an actual cash value of $20,000. You are upside down on your loan. Now imagine you get into a major accident and your car is declared a total loss. Your collision coverage is going to pay out. But what do they pay? They pay the fair market value of the car right before the crash. They're going to write a check for $20,000. But you still owe the bank $25,000. So the insurance money pays off most of the loan, but you are still left with a $5,000 bill for a car that no longer exists. You are making payments on a ghost. That $5,000 difference is the gap. And gap insurance is a specific policy designed to cover it. Now, what would Dave Ramsey say about this? He would call gap insurance a stupid tax. His point is that you should never be in a position to need it in the first place. You avoid it by making a large down payment, at least 20%, so you're never upside down. You avoid it by buying a reliable used car, instead of a new one that depreciates so quickly. You avoid it by taking out a shorter loan term so you build equity faster. However, he also lives in the real world. He knows that millions of people are already in this exact situation. So if you currently have a car loan and you are upside down, then yes, you absolutely need gap insurance. Not having it is taking a foolish gamble. The goal is to structure your car purchase so you never need it, but if the mistake has already been made, you have to protect yourself from that potential $5,000, $10,000, or even larger devastating loss. So the picture is becoming clearer. For a low-value, paid-for car, liability only is often the smart play. For a more valuable paid-for car, full coverage with a high $1,000 deductible is the way to go, using your emergency fund as your first line of defense. And for any car with a loan, full coverage isn't a choice, it's a requirement, and you have to honestly assess if you need gap insurance to protect yourself. But we're still not done building your perfect auto policy. Liability, collision, and comprehensive are the big three, the pillars of your coverage. But when you look at your policy documents, you'll see a list of other, confusing options. Things like uninsured motorist coverage, medical payments coverage, and personal injury protection. Are these just unnecessary add-ons designed to pad the insurance company's profits? Or are they crucial protections that could save you from financial ruin? The answers might surprise you. Let's start with uninsured and underinsured motorist coverage. often abbreviated as and UIM. To understand why this is so critical, let's paint a picture. You're driving home, obeying every law, and you stop at a red light. Suddenly, you hear the screech of tires and feel a massive impact from behind. Your head snaps back. Your car is violently pushed into the intersection. You're dazed, hurt, and your $1,000 phone has flown somewhere into the abyss of the floor mats. The other driver stumbles out, full of apologies, but then delivers the gut punch. "I'm so sorry. I don't have any insurance." In that moment, your entire financial life could flash before your eyes. Who pays for your hospital visit? Who pays for the weeks of physical therapy you might need? Who pays for the wages you'll lose because you can't work? If you don't have uninsured motorist coverage, the answer is terrifyingly simple. You do. You pay for all of it. All because someone else broke the law and acted irresponsibly. This is precisely why Dave Ramsey considers this coverage an absolute, non-negotiable must-have. It's not a luxury, it's a shield. A shield protecting you and your family from the financial fallout of someone else's terrible decision. Think about the statistics. Depending on the state you live in, as many as 1 in every 4 or 5 drivers on the road with you right now could be uninsured. Nationwide, the average is about 1 in 8. Do you feel comfortable playing Russian roulette with those odds every time you get behind the wheel? Uninsured motorist bodily injury coverage steps in and acts like the other driver's insurance. It pays for your medical bills, your pain and suffering, and your lost wages. It's the hero you didn't know you needed, waiting in the wings. Now, what about underinsured motorist coverage? This is the equally dangerous but sneakier cousin. Let's go back to our crash scene. This time, the driver who hit you does have insurance. Relief washes over you, but it's short-lived. You find out they have the absolute bare minimum liability coverage required by the state. Let's say that's $25,000. But your medical bills alone, after a multi-day hospital stay and a required surgery, are already at $70,000 and climbing. The other driver's policy pays out its max of $25,000, and then that's it. They're done. You are now on the hook for the remaining $45,000, plus any future therapy, plus all your lost income. This is where underinsured motorist, or UIM, saves the day. It bridges the gap. If you have UIM coverage up to, say, $100,000, your policy would kick in after the other driver's policy is exhausted, covering that remaining $45,000 deficit and giving you more room for future expenses. From a Ramsey perspective, and UIM coverage is the ultimate defensive move. You've worked too hard building your emergency fund, saving for retirement, and paying down debt to have it all wiped out by a stranger's irresponsibility. He would tell you to get UM/UIM coverage that at least matches your bodily injury liability limits. If you're protecting others with two $5,500 limits, you absolutely need to be protecting yourself with the same amount. It's about consistency and valuing your own financial health, as much as you value protecting yourself from a lawsuit. So that covers injuries caused by others. But what about the gray areas? What about smaller medical costs regardless of who is at fault? This brings us to medical payments coverage, or MedPay. MedPay is a different kind of beast. It's a relatively small amount of coverage, typically ranging from $1,000 to $10,000, that covers medical expenses for you and your passengers after an accident, no matter who is at fault. If you accidentally back into a pole in a parking lot and need stitches, MedPay can cover it. If a passenger in your car is injured in a fender bender, MedPay can cover their initial ambulance ride or emergency room visit. It pays out quickly, without the hassle of determining fault or waiting for another insurance company to accept liability. So, is this something Dave Ramsey would recommend? This is where his advice gets more nuanced and forces you to look at your entire financial picture. Dave is a fierce advocate for having excellent health insurance. If you have a great health insurance policy with a low deductible, say $500, then MedPay starts to look a bit redundant. Why pay an extra premium on your car insurance for a benefit that your primary health insurance already provides? Dave would call this paying for the same protection twice, and he's all about eliminating waste. In this scenario, you might decline MedPay and save that money, confident that your health insurance has your back. However, let's be brutally honest. A lot of people today have high-deductible health plans. It's a common way to keep monthly premiums down. If your health insurance has a $5,000 deductible, that means you have to pay $5,000 out of pocket before your insurance even starts to kick in. Suddenly, having a $5,000 MedPay policy on your car insurance looks brilliant. After an accident, you could use your MedPay to cover your entire health insurance deductible. This prevents you from having to raid your emergency fund for that $5,000. It acts as a perfect bridge, a specific tool for a specific job. The Ramsey-approved approach here is to be a savvy consumer. Look at your health insurance policy. Know your deductible. If it's high, adding a corresponding amount of MedPay is a smart strategic move. If your deductible is very low and you have great coverage, MedPay is likely an unnecessary expense you can cut. Now, things get even more complex with the third type of coverage in this category: personal injury protection, or PIP. For many people, this is the most confusing one of all. PIP is like MedPay on steroids, and in about a dozen states it's not optional, it's mandatory. These are known as no-fault states. The concept of a no-fault state is simple in theory: to keep small injury claims out of the court system. In these states, if you are injured in an accident, your own PIP coverage is your first line of defense for medical bills, up to a certain limit regardless of who caused the accident. You deal with your own insurance company first, which speeds up the payment process immensely. But PIP is broader than MedPay. Not only does it cover medical bills, but it also typically covers other economic losses. The big one is lost wages. If you can't work for 3 weeks because of an injury from the accident, PIP can help replace a portion of your paycheck. It can also cover things like physical therapy, rehabilitation, and even services you can no longer perform like childcare or cleaning, which you now have to hire someone to do. So what's the Ramsey take on PIP? First, if you live in a no-fault state where it's legally required, the debate is over. You have to buy it. The real question then becomes how much PIP to buy. The state will have a minimum, but you can usually purchase much higher limits. This is where, once again, you must look at your other financial protections. Dave Ramsey is a massive proponent of having good long-term disability insurance. This is a separate policy that replaces a significant portion of your income if you become disabled and can't work for an extended period. If you have a solid disability insurance policy in place, you may not need to pay extra for the highest possible lost wages benefit on your PIP coverage. Your disability insurance is the heavy lifter designed for that exact purpose. Relying on PIP for long-term income replacement is like using a spare tire to drive across the country. It's not what it was designed for. Therefore, the smart play is to coordinate your benefits. Look at your health insurance for medical coverage. Look at your disability insurance for income replacement. Then buy the amount of PIP coverage that fills in the gaps without being redundant. If it's optional in your state, the analysis is very similar to MedPay. Weigh it against your health and disability coverage to see if it's a necessary layer of protection or just an extra cost. We've now built a fortress around you and your finances, protecting you from lawsuits and injuries. We've covered liability, the shield that protects your assets from others. And we've just covered the coverages that protect you and your passengers from the financial pain of injuries. But through all of this, we haven't talked about the giant piece of metal, plastic, and glass at the center of it all. What about your car? This is where the script flips. This is where Dave Ramsey's advice moves from buy more protection to maybe you don't need protection at all. We're about to dive into the two types of coverage that actually fix your car: collision and comprehensive. And the question of when you should boldly, confidently, and strategically drop them completely might be the single biggest money saver in your entire insurance policy. So let's break this down. Collision coverage pays to repair or replace your car if you're in an accident with another object. Another car, a pole, a fire hydrant, you name it. If you cause the accident, it's the coverage that fixes your car. Comprehensive, on the other hand, is for almost everything else. It's the acts of God and acts of chaos coverage. A tree branch falls on your hood during a storm? Comprehensive. A deer decides to play chicken with your grill on a back road? Comprehensive. Your car gets stolen, vandalized, or catches fire? You guessed it, comprehensive. Together, they are what most people call full coverage, a term that insurance agents love and Dave Ramsey hates, because it implies you're covered for everything, which you never are. The real name for this bundle is collision and comprehensive, and they are designed to do one thing: restore your car to its pre-accident condition, or if that's not possible, give you a check for its value. And that word, value, is where the entire Ramsey strategy hinges. It's the key that unlocks the whole puzzle. See, the moment you drive a new car off the lot, it starts a relentless financial battle against an enemy it can never defeat: depreciation. It's a sinking ship, losing value every single second of every single day. When the car is new and worth, say, $40,000, paying for collision and comprehensive is a no-brainer. The potential loss is massive. You're paying a few $100s to protect a $40,000 asset. That's a good bet. But what about when that car is 8, 10, or 12 years old? It's been faithful. It's got dings, scratches, and 150,000 miles on the odometer. It's no longer a $40,000 asset. Now, according to Kelley Blue Book, it might only be worth $4,000. Yet, you're still paying that insurance premium, maybe a little less than before, but you're still paying it. Every single month. You are dutifully bailing water out of a $4,000 ship. The question is, at what point does the cost of the buckets and the effort of bailing become more expensive than the ship itself? This is where Dave Ramsey draws a very clear, very bold line in the sand. His philosophy isn't based on feelings or what-ifs. It's based on cold, hard math. He advocates for a concept that sounds radical at first, but is the cornerstone of building wealth: becoming self-insured. Here's the rule, the mathematical trigger that tells you when to pull the plug. Dave's general guideline is this: when the annual cost of your collision and comprehensive coverage exceeds 10% of your car's actual cash value, you should seriously consider dropping it. Let's put that into a real-world scenario. Let's go back to that trusty 10-year-old car worth $4,000. You look at your insurance policy and see that you're paying $50 a month or $600 a year, specifically for the collision and comprehensive portion of your bill. Now let's do the math. What is 10% of your car's value? 10% of $4,000 is $400. You are paying $600 a year to protect a $4,000 asset. According to the Ramsey rule, you're on the losing side of that bet. You are paying more than the 10% threshold. At this point, Dave would tell you to pick up the phone, call your insurance agent, and drop both coverages. And I can hear the alarm bells going off in your head right now. But what if I get into a wreck the next day? I'll get nothing from my car. I'll be out $4,000. And the answer to that is yes, you would be. This is the moment where you have to shift your thinking from a mindset of fear to a mindset of financial strategy. Insurance is a business. The insurance company has herds of actuaries, math geniuses, who calculate the precise odds of you getting into an accident. They are betting that the money you pay them in premiums will be more than the money they have to pay you in claims. And most of the time, for most people, they are right. That's how they build giant skyscrapers. When you have a low-value car, you are paying them to take on a very small risk. If you total your $4,000 car, the most they will ever have to pay you is $4,000 minus your deductible. Yet, you might pay them $600 or $700 or even $800 a year for that protection. Over 5 years, you could pay them $4,000 in premiums, the entire value of the car, even if you never have an accident. By dropping the coverage, you are firing the insurance company from that specific job. You are saying, "Thank you for your service, but I'll take it from here." You are choosing to self-insure. You are taking that $600 a year you would have paid in premiums and putting it in your own pocket. You are making a calculated bet on yourself. After 1 year, you've saved $600. After 2, $1,200. After 6.5 years of no accidents, you have saved the entire $4,000 value of the car. You have effectively paid for your own car replacement with the money you saved on insurance. But, and this is the most important, but in the entire video, this strategy has 2 absolute, non-negotiable prerequisites. Trying to do this without them is not a savvy financial move. It's just reckless gambling. First, you must own the car outright. If you have a car loan, the lender, whether it's a bank or a credit union, legally requires you to maintain collision and comprehensive coverage. They have a lien on the title, and they are not going to let you risk their asset. So, this strategy is only for people who have a paid-for car. This is yet another reason Dave Ramsey hammers on getting out of debt. It unlocks freedoms like this. Second, and this is the big one, you must have an adequate emergency fund. Remember baby step 1 and 3? Saving $1,000 and then building that up to 3 to 6 months of expenses? This is why. Your emergency fund now serves as your personal insurance company. If you drop coverage on your $4,000 car and then you total it a week later, it's a frustrating, annoying, terrible day. But it is not a financial catastrophe. It's an inconvenience. You dip into your emergency fund, you go buy another $4,000 car with cash, and you move on with your life. You don't have to take out a loan. Your life isn't derailed. If you don't have an emergency fund, you cannot self-insure. Dropping coverage without a cash cushion to handle the potential loss is like jumping out of a plane without a parachute. You're just hoping you land somewhere soft. A proper emergency fund is your parachute. It allows you to take calculated, mathematical risks that save you money in the long run. So how do you do this? It's a simple 3-step process. Step 1. Find your car's actual cash value. Don't guess. Don't use the price you paid for it 5 years ago. Go to a site like Kelley Blue Book, kbb.com, or NADA Guides. Enter your car's year, make, model, mileage, and condition honestly. This will give you the private party sale value. That's your number. Step 2. Find the annual cost of your collision and comprehensive coverage. Call your agent or look at your policy documents. You need to isolate the cost of just these 2 coverages, not your entire bill, which includes liability. Ask your agent, how much will my bill go down per year if I drop only collision and comprehensive? Step 3. Do the math. Divide the annual insurance cost by your car's value. If that number is greater than 0.10 or 10%, it's time to make the call. This is a major step. It's moving from defense to offense with your money. You stop paying a company to manage a small and decreasing risk and start managing it yourself, pocketing the savings. It's about recognizing when an asset like an old car is no longer worth the cost of insuring it. You wouldn't pay $100 a year to insure a 10-year-old washing machine, would you? At some point, your car moves into that same category. It's a household appliance that gets you from A to B, and you have the cash on hand to replace it if it breaks. But what if your car is still too valuable to drop coverage? What if you have a $15,000 car and you have to keep collision and comprehensive? Are you just stuck paying a high premium? Absolutely not. For the vast majority of people listening, dropping the coverage isn't the right move yet. But that doesn't mean you're powerless. The secret to dramatically lowering your bill without giving up this crucial protection lies in a single number on your policy that you probably chose years ago and haven't thought about since. It's not about if you're covered, but how much you're willing to pay out of pocket first. I'm talking about your deductible, and understanding how to manipulate this one number is the single fastest way to put hundreds of dollars back in your bank account starting today. Let's break this down. Your deductible is the amount of money you have to pay out of your own pocket for a covered claim before your insurance company starts paying. Think of it as your copay for a car catastrophe. If you have a $500 deductible and you get into an accident that causes $3,000 in damage, you pay the first $500, and your insurance company covers the remaining $2,500. Simple enough. But here's the part that trips everyone up. Most people, driven by fear, choose the lowest deductible possible. They pick a $250 or $500 deductible because they are absolutely terrified of having to come up with a larger amount in an emergency. And on the surface, that logic seems sound. Who wants to be on the hook for $1,000 after a stressful accident? But this is fear-based thinking, and fear-based financial decisions are almost always the most expensive decisions you can make. You are paying a guaranteed higher price every single month to avoid a potential future cost. It's like paying a worry tax. The insurance companies know this. They love when you pick a low deductible. Why? Because it means they get more of your money every month without fail. A lower deductible signals to them that you are transferring more of the risk to them, and they will charge you a premium for that privilege. A very, very high premium. This is where Dave Ramsey's philosophy cuts through the noise with a simple, powerful principle. Self-insure the small stuff so you can afford to have the insurance company cover the big stuff. His recommendation is blunt and has been the same for decades. You should have a $1,000 deductible on both your collision and comprehensive coverage. For some people hearing this for the first time, that number sounds terrifying. $1,000. But let's look at the math because the numbers don't lie. Let's imagine 2 people, John and Maria. John is cautious. He has a $250 deductible. His monthly premium is $180. Maria follows Ramsey's advice. She has a $1,000 deductible. Her monthly premium is only $110. John is paying $70 more than Maria every single month. That's $840 more per year. Think about that. John is paying nearly $1,000 extra every year to avoid the possibility of having to pay an extra $750 in the event of an accident. He is guaranteed to lose $840 to avoid a situation that might never even happen. Over 5 years, assuming no accidents, Maria is $4,200 richer than John, just from this one single decision. She could buy a whole other car with her savings. Now let's say in year 3 they both have the exact same accident. A deer runs out, causing $4,000 in damage. John files his claim. He feels smug as he writes a check for only $250. The insurance covers the other $3,750. Maria files her claim. She has to write a check for $1,000. The insurance covers the other $3,000. John thinks he won. But did he? By that point, John had already paid the insurance company an extra $2,520 in higher premiums. So even after paying his lower deductible, he is still thousands of dollars behind Maria. Maria, on the other hand, easily covers her deductible and is still way ahead financially. She played the long game. She won. Now the big question, the one you're probably screaming at the screen right now is, but where do I get that $1,000 if something happens? I don't just have that lying around. And that, right there, is the entire key. This strategy is completely dependent on one thing: having an emergency fund. This is why Dave Ramsey's baby step 1 is to save a $1,000 starter emergency fund. That money is not for pizza. It's not for vacation. It's for emergencies. It's for a blown transmission. It's for a leaky roof. And yes, it is for your car insurance deductible. Once you have that $1,000 saved and sitting in a separate savings account, you have officially given yourself permission to raise your deductible. You are no longer gambling. You are prepared. You have taken control. You've looked the insurance company in the eye and said, I'll handle the small stuff. I can cover a $1,000 problem. I only need you for the big stuff, the truly catastrophic, life-altering events where the bill is $10,000, $20,000, or $50,000. By doing this, you are transforming the purpose of insurance in your life. It ceases to be a maintenance plan for every little ding and scratch, and becomes what it was always intended to be: a shield against financial ruin. Think about the psychology of it. When you have a low deductible, you're tempted to file a claim for every little thing: a cracked windshield, a scraped bumper in a parking lot. And every time you file a claim, you risk your rates going up. It creates a cycle of dependency. But when your deductible is $1,000, your mindset shifts. That parking lot scrape that's going to cost $700 to fix? You don't even think about calling the insurance company. You just get it fixed. You pay cash. It's an inconvenience, not a crisis. You're handling your own business. You are self-insuring. So here is your action plan. First, if you do not have at least $1,000 saved for emergencies, that is your only mission. Get gazelle intense. Deliver pizzas, sell stuff on Facebook Marketplace, cut your spending to the bone until you have that cash in the bank. Do not pass go, do not collect $200. Second, once that emergency fund is in place, you are going to pick up the phone. You're going to call your insurance agent, and you're going to say these exact words. Hi, I'd like a quote to see how much I would save by raising my collision and comprehensive deductibles to $1,000. That's it. It's a simple 5-minute phone call. The person on the other end of the line will probably be surprised. They might even try to talk you out of it, telling you about the risk. But you will know better. You'll know that the real risk isn't the $1,000 deductible you're prepared to pay, but the hundreds of dollars you're guaranteed to lose every year by paying for overpriced, low-deductible insurance. You'll ask for the numbers and you will see in black and white the instant savings. Could be $30, $50, even $80 a month. That's real money that goes back into your budget, to attack debt, to build wealth, to live your life. This isn't just about saving a few bucks. It's about a fundamental shift from living in financial fear to operating from a position of strength and preparation. But what about the car itself? What if your car is so old that paying for full coverage doesn't even make sense anymore? There comes a point where you might be paying more in insurance than the car is actually worth. And that's a whole different calculation. It's a calculation that separates the rookies from the veterans in the personal finance game. It's where you move from just paying bills to making strategic decisions with your money. This is the moment where many people get stuck in a loop, paying hundreds of dollars a year to protect an asset that's barely worth a few thousand. Think about it. You're insuring your brand new iPhone, right? You pay for Apple Care. But are you still paying for insurance on your 8-year-old flip phone? Of course not. The risk isn't worth the premium. The same logic applies to your car, it's just on a bigger scale. So, how do you know when it's time to make the cut? Dave Ramsey has a very simple, yet powerful rule of thumb that acts as your guide. The rule is this: when the annual cost of your collision and comprehensive coverage exceeds 10% of your car's actual cash value, you need to seriously consider dropping it. Let's break that down. Not your total insurance premium, just the part you pay for collision and comprehensive. These are the coverages that fix or replace your car if it's damaged or stolen. Your liability coverage? That's non-negotiable. You must always have that to protect you from financial ruin if you hurt someone or damage their property. We are only talking about the insurance on your own vehicle. Let's put this into a real-world scenario. Meet Jessica. Jessica is a classic Dave Ramsey follower. She's debt-free except for her mortgage, has a fully funded emergency fund of 6 months of expenses, and she's driving a 12-year-old, paid-for Toyota Camry. It's got 150,000 miles, a few dings and scratches, but it runs like a top. It's a great, reliable car. Every year, Jessica gets her insurance renewal, and she pays it without thinking. Her total annual premium is $1,400. She recently looked at her policy breakdown and saw that $800 of that premium was for liability, and $600 was for collision and comprehensive with a $1,000 deductible. So Jessica has been paying $600 a year every year to protect her Camry. The first step in our calculation is to figure out what the car is actually worth. Not what she thinks it's worth, not what she paid for it, but what an insurance company would write her a check for if she totaled it tomorrow. This is called the actual cash value, or ACV. She goes to Kelley Blue Book online, puts in her car's information, the year, make, model, mileage, and condition, and gets a value. The private party value for her car in good condition is $5,000. Now we apply the Ramsey rule. What is 10% of her car's value? It's $500. Jessica is paying $600 a year for her collision and comprehensive coverage. $600 is more than $500. Ding ding ding. According to the rule, it's time for her to think about dropping the coverage. But let's go even deeper than the rule of thumb. Let's look at the cold, hard math of the risk she's paying to avoid. Her car is worth $5,000, and her deductible is $1,000. This means that in a worst-case scenario, if her car is completely totaled, the absolute maximum her insurance company will ever pay her is $4,000. So, she is paying $600 every single year for a policy that has a maximum potential benefit of $4,000. If she drives for 1 year without an accident, she's paid $600 for nothing but peace of mind. If she drives for 2 years, that's $1,200. 3 years, $1,800. In a little over 6.5 years of paying that premium, she will have paid the insurance company more than $4,000, the entire maximum amount they would ever pay her back. She's essentially betting $600 that she will total her $5,000 car this year. And the insurance company is betting $600 that she won't. Who do you think has more data on their side? Who do you think usually wins that bet? This is where the concept of being self-insured comes into play. This is not about being reckless. It is the exact opposite. It's about being so financially prepared that you can afford to take on a small, calculated risk yourself, rather than paying a company to take it on for you. The key to this entire strategy, the non-negotiable foundation, is baby step 3. A fully funded emergency fund of 3 to 6 months of expenses. For Jessica, who has a $20,000 emergency fund sitting in a money market account, the question changes. It's no longer, can I afford to lose my car? The question becomes, if I total my car tomorrow, would writing a $5,000 check to buy another reliable used car derail my financial life? For her, the answer is a clear no. It would be annoying for sure. Nobody wants to go car shopping unexpectedly, but it wouldn't be a catastrophe. It wouldn't put her into debt. It wouldn't stop her from paying her mortgage or buying groceries. She can absorb the blow. She has become her own insurance company for her car's value. Now the fear immediately creeps in. I can hear it now. But what if I drop the coverage and get into an accident the very next day? Yes, that could happen. That is the risk. But you have to weigh that risk against the mathematical certainty of paying that $600 premium every single year, year after year. By dropping the coverage, Jessica immediately gives herself a $600 a year raise. She can take that money and invest it, or even better, put it into a separate sinking fund labeled car replacement. In just a few years, she'll have saved enough to buy a replacement car outright, all with the money she would have just been sending to the insurance company. This is a mindset shift. You're moving from a position of financial fragility, where a fender bender could ruin your month, to a position of financial strength, where you can handle life's bumps and dings because you prepared for them. You're not paying for peace of mind anymore. You've built your own peace of mind with a pile of cash. So what's the action plan? First, you need to find out what your car is worth. Don't guess. Go to a site like kbb.com or edmunds.com. Be brutally honest about the condition. Is it fair or good? Don't choose excellent, unless it's just rolled off the showroom floor. You want the private party sale value, as this is closest to the actual cash value an insurer would use. Second, pull out your insurance policy declaration page. You probably get it in the mail or online. Look for the line items. You'll see bodily injury liability, property damage liability, and then you'll see collision and comprehensive. It will show you the premium for each one for your 6-month or 1-year term. Add up the cost for only collision and comprehensive and double it if it's a 6-month term to get your annual cost. Third, do the math. Is that annual cost more than 10% of your car's value? Finally, and most importantly, look at your savings. Do you have a fully funded emergency fund that could cover the replacement of your car without causing a crisis? If the answer to both of these questions is yes, if the math makes sense and your savings are in place, then it's time to pick up the phone and make a change to your policy. It's a powerful step towards taking control of your money and cutting out expenses that no longer serve you. But dropping coverage is the nuclear option. It's a huge move. What if you're not ready for that? Or your car is still too valuable? Are there other levers you can pull? What about the secrets hidden inside your policy that could be costing you hundreds, even thousands, of dollars every single year without you even knowing it? That's where the real game is played. Let's pull back the curtain. The first place most people get fleeced isn't in the big, obvious decisions. It's in the small print, the little line items that sound like a good idea, but in reality, are either redundant or a complete waste of money. Let's start with 2 little acronyms you've probably seen but never truly questioned. MedPay and PIP. MedPay stands for Medical Payments Coverage. PIP is Personal Injury Protection. In simple terms, they are designed to cover medical expenses for you and your passengers after an accident, regardless of who is at fault. In some states called no-fault states, PIP is mandatory and more comprehensive, often covering things like lost wages in addition to medical bills. MedPay is usually optional in other states. Now, on the surface, this sounds great, right? Immediate medical coverage. No waiting for the other driver's insurance to pay up. Feels like a responsible choice. But here's the question Dave Ramsey would have you ask. What other insurance do you have that already does this? For the vast majority of people with a decent job, the answer is health insurance. You are paying a premium every single month for a health insurance policy. So why in the world would you pay a second premium to an auto insurance company for the exact same purpose? It's like buying 2 tickets for the same movie seat. It makes no sense. Think about it this way. Let's say you have a good health insurance plan with a $1,000 deductible and a $5,000 out-of-pocket max. But your auto insurance agent sold you on a $10,000 MedPay limit just to be safe. You get into a minor accident and have $3,000 in medical bills. Your MedPay covers it. Great. But what did you really accomplish? You paid an extra premium for years, maybe $50 or $100 a year, just to avoid using the health insurance you already pay for. If you had just used your health insurance, you would have paid your $1,000 deductible out of your emergency fund, your health plan would have covered the rest, and you'd be $1,000 closer to hitting your out-of-pocket max for the year, which protects you from any other health issues that might come up. Instead, you paid the auto insurer for the privilege of not using the primary tool you have for this exact situation. The Ramsey approach is to eliminate redundancy. Look at your health insurance policy. If you have a solid plan, you can drastically reduce or, in some states, even eliminate MedPay. Maybe you keep a small amount, say $1,000 or $2,000, just to cover your health insurance deductible immediately without having to tap your emergency fund. But paying for a $10,000 or $20,000 MedPay policy when you have great health insurance is one of the biggest hidden wastes in the insurance world. If you're in a PIP state, you may be required to carry it, but you should still look at the available deductible options. Choosing a higher PIP deductible, knowing your health insurance is the backup, can save you a significant amount of money. So that's one lever. Stop paying twice for medical coverage. But this is where it gets interesting because the very next line item on your policy is often one that people treat the exact opposite way, to their own peril. And that is uninsured and underinsured motorist coverage. UM and UIM. If MedPay is the coverage you often don't need, UM/UIM is the one you absolutely cannot afford to be without. This is not the place to get cheap. This coverage protects you. It protects your family, your health, and your financial future if you are hit by someone who has no insurance, or who has the pathetic state minimum coverage that wouldn't even cover a fraction of a serious injury. Let's paint a picture. You're on your way home from work. You've been following the baby steps. You're debt-free except the house. You have a full emergency fund and you're investing 15% of your income. You're winning. Then someone runs a red light and plows into you. Your car is destroyed. You're seriously injured, airlifted to a hospital, and you end up with $250,000 in medical bills and lost wages. Then you get the call. The driver who hit you, he has no insurance. He has no job. He has no assets. You can sue him, but as the old saying goes, you can't get blood from a stone. Without uninsured motorist coverage, you are on your own. Your life is turned upside down by the irresponsibility of a total stranger, and your entire financial future, everything you've worked for, is now at risk. Your health insurance will help, but what about the lost wages? The long-term physical therapy? The permanent disabilities? This is what UM/UIM is for. It steps in and acts as the insurance the other driver should have had. It is the single most important moat you can build around your financial castle. The secret here isn't to cut it, it's to get the right amount. Most people just accept whatever the default is, or they cheap out and get the state minimum. This is a catastrophic mistake. Here's the rule of thumb. Your uninsured and underinsured motorist limits should match your bodily injury liability limits. If you have $250,000/$500,000 of liability coverage to protect others from you, you should have the exact same amount of coverage to protect you from others. Why would you value a stranger's health more than your own? It's insane not to match them. The cost to increase these limits is usually marginal, but the protection it provides is monumental. Now let's move from the critical to the trivial. The little add-ons. The death by 1,000 paper cuts. I'm talking about things like rental reimbursement and towing and labor. Again, these sound responsible. Oh, for just $6 a month, we'll cover a rental car if yours is in the shop. For just $3 a month, you get roadside assistance. This is a classic example of insuring against a minor inconvenience, not a catastrophe. This is what your emergency fund is for. Let's break it down. Towing and labor might cost you, say, $40 a year. Over 10 years, that's $400. How many times have you needed a tow in the last decade? Maybe once or twice. A single tow costs about $100 to $150. You are almost always better off just paying for it out of pocket when it happens. Furthermore, many people are already paying for this service elsewhere. Do you have AAA? Does your credit card offer roadside assistance as a perk? Does your car's manufacturer warranty include it? People are often double or triple paying for this and don't even realize it. The same logic applies to rental reimbursement. This coverage might cost $60 or $80 a year. First, ask yourself, do you even need it? If your car is in the shop for a week, do you have a second car in the family? Can you work from home? Could you borrow a car from a friend or family member? If the answer is yes, you're paying for a convenience you don't need. Even if you don't have those options, you have an emergency fund. Paying $300 for a week-long car rental out of your emergency fund once every 10 years is far cheaper than paying an insurance company $800 over that same decade for the privilege. This is the core of the Ramsey philosophy. Don't pay an insurance company to manage small, predictable risks. That's your job. Your emergency fund is your insurance for blown tires, dead batteries, and needing a rental car for a few days. You pay the insurance company to protect you from the major catastrophes, the $500,000 lawsuits, the life-altering injuries from an uninsured driver. By cutting these tiny, unnecessary coverages, you can free up $100, maybe $200 a year. That's real money that can go toward your debt snowball or your retirement accounts, instead of just padding the insurance company's profits. So we've recalibrated your medical payments to avoid redundancy. We've fortified your uninsured motorist coverage to protect your entire net worth. And we've stripped out the junk convenience coverages that your emergency fund should be handling. We've just found hundreds of dollars by looking inside the policy. But what if the biggest savings are found by looking outside? What if the way you shop for insurance is fundamentally broken, and the industry is counting on you to keep making the same mistake year after year? We're about to blow that wide open. The single biggest financial mistake you can make with car insurance isn't choosing the wrong deductible or having the wrong liability limits. It's believing in a myth so powerful, so deeply ingrained in our culture, that insurance companies have built their entire business model around you believing it. The myth is that loyalty is rewarded. You've heard it your whole life. Stick with a company, be a good customer, and they'll take care of you. In almost every other area of business, that's true. But in the world of insurance, loyalty is often punished. It's a concept industry insiders call the loyalty penalty, or price optimization, and it's costing you a fortune. Here's how it works. When you first sign up with an insurer, they often give you a fantastic competitive rate. They reel you in. You're happy. You set up autopay and you forget about it. A year later, your renewal comes and the price has gone up. Maybe just $20 or $30. You think, oh, inflation. Everything's more expensive. The next year it goes up again. Another $35. It's a slow boil. You don't notice the frog in the pot. But behind the scenes, a sophisticated algorithm is at work. The insurance company's data shows them that customers who have been with them for 3, 5, or 10 years are far less likely to shop around. They've developed inertia. They're sticky. So the algorithm identifies you as a loyal, sticky customer and concludes you can tolerate a higher price increase than a new customer would. They are literally charging you more because you are a loyal customer. They are banking on the fact that the hassle of switching seems greater than the small, incremental price hikes they hit you with year after year. Over a decade, this loyalty tax can add up to thousands of dollars in overpayments for the exact same coverage you could get elsewhere for less. This completely shatters the second part of the broken system. The hunt for the cheapest insurance company. People are always asking, who's the best carrier? Who's the cheapest? That is the wrong question. There is no single cheapest insurance company. The cheapest company for your 22-year-old nephew who drives a Honda Civic is not the cheapest company for you, a 45-year-old with a minivan, a perfect driving record, and an 800 credit score. The rates are a complex cocktail of dozens of factors. Your age, your zip code, your driving history, your credit score, the car you drive, and crucially, the insurance company's own internal business goals at that exact moment in time. Maybe Geico just paid out billions for hurricane claims in Florida and needs to raise rates nationwide to recoup their losses. At the same time, maybe a smaller company like Progressive or a regional mutual company had a great year and is aggressively trying to gain market share in your state, so they're offering rock-bottom prices to people with your exact profile. The cheapest company for you today might be the most expensive one for you in 18 months. It is a constantly shifting landscape. Believing that one company is the best and sticking with them out of blind loyalty is like trying to navigate a maze with your eyes closed. You're going to hit a wall. So if the system is designed to penalize loyalty, and there's no single best company, how do you win? You beat them at their own game. You force them to compete for your business. And you do it by understanding the one secret Dave Ramsey has been screaming from the rooftops for years, the secret the big insurance giants hope you never figure out. It's not about who you buy from. It's about how you buy. There are 3 ways to buy insurance. The first 2 are what most people do, and they are flawed. First, you have the captive agent. This is your friendly neighborhood State Farm or Allstate agent. They might be a great person, but they are captive. They work for one company and one company only. They can only sell you State Farm products. They can't tell you if Nationwide or Progressive has a better deal for you. Their job is to keep you with their brand, not to find you the best value on the open market. Second, you have the direct writers. These are the Geicos and Progressives of the world, whose jingles you can't get out of your head. You go to their website or call their 1-800 number. Here the burden is entirely on you. You have to go to 5 different websites, enter your information 5 different times, try to compare 5 different quotes that are all formatted differently, using different jargon. It's confusing, it's time-consuming, and it's exactly what they want. They know that after the 3rd website, you'll probably just give up and pick one that seems good enough. But there is a 3rd way. The smart way. The Ramsey way. You use an independent insurance agent or broker. This is the game changer. An independent agent doesn't work for the insurance company. They work for you. They are not captive to one brand. Instead, they have contracts with dozens of different insurance carriers, the big names and smaller, excellent companies you've never even heard of. Their job isn't to sell you a specific product. Their job is to take your unique situation, your needs, your profile, and shop it across their entire network of companies to find the one that offers the absolute best coverage for the absolute best price. They do all the legwork. They translate the jargon. They compare the policies on an apples-to-apples basis. They are your personal, professional insurance shopper, and their service costs you nothing. They're paid a commission by the insurance company you ultimately choose. A commission that's already built into the price of any policy, no matter how you buy it. Think about it like this. Imagine you needed to buy a new big screen TV. The captive agent approach is like going to a Sony store. They'll only sell you a Sony. The direct writer approach is you spending your entire Saturday driving to Best Buy, then to Costco, then to Target, trying to compare all the specs and prices yourself. The independent agent approach is like having a professional home theater expert who knows all the brands, Sony, Samsung, LG, Vizio, and who says, based on your room size, viewing habits, and budget, this specific LG model is the best value on the market for you right now. Which approach is going to get you the best result with the least amount of stress? This isn't just theory. This is about real money. A friend of mine, let's call him John, was with the same big-name insurance company for 15 years. He was the perfect loyal customer. His rates for 2 cars and a home policy had crept up to over $4,000 a year. He just assumed that was the cost of being insured. He finally listened and called an independent agent. The agent took his information and came back 2 days later. He found a company John had never heard of that offered the exact same coverages, literally line for line the same, for $2,600 a year. A $1,400 a year savings. Why? Because John's old company was no longer competitive for his profile in his area, while the new company was actively looking for customers just like him. John was paying a $1,400 a year loyalty tax, and he didn't even know it. That $1,400 is not just pocket change. In the Dave Ramsey world, that's over $100 a month you can throw at your debt snowball. That's an extra $100 a month you can invest for retirement. That's a fully funded emergency fund in 3 months. By making one phone call, John fundamentally changed his monthly budget and accelerated his financial goals. He stopped being a passive victim of the system and took control. This is the difference. It's about being intentional. It's about not letting these giant corporations profit from your inertia. And the best part? The independent agent will do this for you every single year, ensuring you always have the best rate the market can offer. So now you know the secret. You've raised your deductibles to save money. You've confirmed you have the right liability limits to protect your net worth. And now you've broken free from the loyalty trap and used an independent agent to shop the market and slash your premiums. You are in the top 1%. You've done everything right. But there's one final piece of the puzzle. A simple mental mistake that can flush all this hard work down the drain the moment you actually need to use your insurance. It's a trap that preys on your emotions after an accident, and it can cost you thousands. We need to talk about what to do and, more importantly, what not to do in the critical hours after a crash. The first rule after a crash is simple. Do not talk to the other driver's insurance company. Ever. They are not your friend. They are not there to help you. Their one and only objective is to close the claim for the lowest possible amount of money. They are a business, and you represent a potential loss on their balance sheet. Within hours, sometimes even sooner, you'll get a call. It will be from an adjuster, and they will sound like the most compassionate, helpful person you've ever spoken to. They'll say things like, "We just want to make this easy for you," or "Let's get this taken care of quickly so you can move on." They'll offer to send a check right away. They'll recommend a body shop from their preferred network that can get you in immediately. This is the trap. The check they offer is a guess, a lowball estimate designed to get you to sign away your rights before the full extent of the damage is known. What if you have a neck injury that doesn't show up for 3 days? Too late, you cash the check. What if the body shop finds hidden frame damage once they start taking the car apart? Too bad, you agreed to the initial amount. Their preferred network of body shops often gets that status by agreeing to use cheaper, aftermarket parts and cutting corners on labor to keep costs down for the insurance company. They work for the insurer, not for you. And then comes the most dangerous part of the call. They will ask you to give a recorded statement. They'll frame it as a simple formality, just to get your side of the story. Do not do it. You are under no legal obligation to give a statement to the other party's insurer. Every question they ask is crafted by a team of lawyers to elicit a response that can be used to assign you partial, or even full blame. Did you say "I'm sorry" at the scene out of pure human decency? They'll use it as an admission of guilt. They'll ask, "Were you in a hurry? Had you just finished a long day at work? Were you listening to music?" These aren't friendly questions. They are fishing for any scrap of information to reduce their company's liability. So what do? You follow a simple, clear, and powerful playbook. First, at the scene of the accident, after ensuring everyone is safe, you call 911. Always, even for a minor fender bender. A police report is an objective, third-party document that is invaluable. Without it, the accident becomes a he said, she said situation, and you don't want to be in that game. Second, you become a documentarian. Use your phone. Take more pictures than you think you need. Get wide shots of the intersection or road. Get medium shots of the cars in their final positions. Get close-ups of every dent, scratch, and broken taillight on both vehicles. Photograph the other driver's license plate, their driver's license, and their insurance card. If there are witnesses, get their names and phone numbers. This evidence is your armor. Third, and this is the golden rule, the only insurance professional you speak to is your own. You call your agent or your insurance company's claims line as soon as you are able. You give them the facts. You send them your pictures. You let them know what happened. They work for you. You pay them to be your advocate. When that friendly adjuster from the other company calls, your response is polite, firm, and unwavering. You say, "Thank you for the call. Please direct all future communication to my insurance provider. Their contact information is on the police report." Then you hang up. You don't argue, you don't explain, you don't engage. You simply redirect them to your champion, to the team you've hired to fight on your behalf. This single action protects you from the emotional stress and the legal jeopardy of dealing with a trained professional whose goal is to pay you as little as possible. This brings us full circle. Connects everything we've talked about. The entire Dave Ramsey philosophy on insurance isn't about a collection of disconnected tips. It's about building a comprehensive system of financial defense. It's about being intentional. Think about it. Having a fully funded emergency fund isn't just for a broken dishwasher. It's the foundation that allows you to confidently choose a higher deductible on your car insurance, saving you hundreds of dollars a year because you know you can handle that $1,000 fender bender without breaking a sweat. Choosing high liability limits, that $500,000, $500,000, $100,000 we talked about, isn't about being paranoid. It's about recognizing the reality of medical costs and legal judgments in today's world. It's about building a firewall that protects your house, your retirement savings, your kids' college funds, everything you've worked your entire life to build, from being wiped out by one catastrophic accident. It's a shield for your net worth. The decision to drop collision and comprehensive coverage on your old, paid-for clunker isn't about being cheap. It's a calculated, mathematical decision. It's about refusing to pay a company $800 a year to insure a car that's only worth $2,000. You're self-insuring that small, manageable risk, and you're redirecting that premium money toward your own goals, like paying off debt or investing for the future. And working with an independent agent? That's not an expense. It's an investment in expertise. It's about having a trusted advisor in your corner who understands the market, who can shop dozens of companies to find you the best value, and who can explain the jargon and the fine print. They are your translator and your advocate, especially when you have to use the very product you bought from them. When you put all these pieces together, you see the bigger picture. Car insurance stops being a frustrating bill you have to pay every month and starts being a strategic tool in your financial plan. It's a deliberate act of risk management. You are intentionally accepting the small, manageable risks like a $1,000 deductible so that you can afford to fully transfer the catastrophic, life-altering risks, like a $1 million lawsuit, to the insurance company. This is the essence of financial peace. It's not about avoiding problems. Problems will happen. Cars will crash. Storms will come. It's about having a plan so robust, so well thought out, that when those problems do happen, they are merely inconveniences, not full-blown financial emergencies. It's about knowing that a bad day on the road won't derail your family's future. It's the quiet confidence that comes from being prepared. So the real lesson from Dave Ramsey's philosophy isn't just about saving money on car insurance. It's about taking control. It's about looking at every aspect of your financial life, even the boring parts like insurance policies, and making intentional, informed decisions that align with your long-term goals. It's about building a fortress around your wealth, brick by boring brick, so you can live and give and build a legacy without the constant fear of it all being taken away. Your homework, if you choose to accept it, is simple. Sometime this week, pull out your car insurance policy declaration page. It's probably in a file folder or saved as a PDF somewhere. Look at the numbers. Are your liability limits high enough to protect your net worth? Is your deductible so low that you're overpaying in premiums? Are you still paying for full coverage on a car that's barely worth a few $1,000s? Ask yourself the hard question. Is this policy designed to truly protect me? Or did I just click the cheapest option I could find online 2 years ago? If you don't like the answers you find, make the call. Talk to an independent agent. Tell them what you're trying to protect. Let them help you build the right plan for your family. This isn't just about a car. It's about your peace of mind. It's about your financial future. And that is a thing worth protecting.